Hi everybody, it's AJ speaking. Welcome back to my Tesla 4Q 2024 financial review. This is part 12. We'll be diving into cash flow. And cash flow has several components. The key components of cash flow comprise operating cash flow and capital expenditures. So on this chart you see Tesla's operating cash flow, how it developed. Just let's start with the numbers. So 4Q operating cash flow was 4.8 billion, which was a sequential decrease of 23%, but an increase of plus 10% year on year. For the full year of 2024, Tesla generated just under 15 billion of operating cash flow. And when you look at this time series, this is actually an all-time high. And by the way, the Bitcoin recognition does not affect operating cash flow because, as the name implies, this looks at cash generation and removes a lot of the, let's call it, accounting shenanigans. And this is a critical indicator of the health of a business. And you can see, despite the significant challenges in the global auto industry and the significant competition faced in China, etc., this number has reached an all-time high. So this is very, very positive, but often not discussed item because people are sometimes overly focused on the P&L because operating cash flow means that we're now in the cash flow statement world, and the cash flow statement world is really where the action happens, and the P&L is really sort of, I consider it mostly a cursory view of a company. And because long term a company to justify any kind of valuation has to generate excess capital generation, and this you can only see in the cash flow statement. And when you look at here on the right hand side of the breakdown of Tesla's cash flow statement, and by the way, this is very standard, there's nothing surprising in here. The operating cash flow is driven by various items, and there's different ways how you can calculate operating cash flow, but the by far most common way is that people start from net income. So the net income is directly the net income that you find in the income statement. So you start from that, and then what you do is you add back non-cash expenses, so things that you took out of net income expenses, you add them back. A big one, and I'm sorry, I have here a typo. Write-downs is a big one because write-down creates an expense in the P&L, but there's no cash outflow against it, and hence why you add it back. The same with share-based compensation, creates an expense in net income, lowers net income, but then in a cash flow perspective, you add this back because, again, there's no cash outflow. And the same is obviously true for depreciation, amortization, and we'll discuss this in more detail in a moment. So the big picture, operating cash flow was quite healthy, even in 4Q 2024, which looked from a P&L perspective not that great, but ultimately cash flow is the key perspective of any company. So then let's dive right into what actually drove operating cash flow in this quarter, and here this analysis is quite useful, but sometimes can be a little hard to understand how this works. So this is not showing the absolute amounts of inventory. It changes how it shows how this changed quarter on quarter. What was driving the change in operating cash flow? So this analysis starts here in the second quarter of 2024. Shows you the key driver from 2Q to 3Q, and then from 3Q to the most current quarter, 4Q. And we're not going to discuss much the third quarter, so let's focus on the fourth quarter. And you can see the positive drivers were the inventory sell down. So Tesla's vehicle production in fourth quarter significantly fell short of the deliveries, and the reason was simply Tesla tried to sell off as much Model Y inventory as possible before the transition after the new year to the new Model Y, because of course people prefer to buy the latest product, and that's why, to get rid of the outgoing Model Ys, you often have to give significant discounts. So obviously you don't want to produce too many, so that's why Tesla dialed back Model Y production. And I think effects of the slowdown in production, anticipation of the new Model Y, etc., and all these demand effects that probably represent a significant driver of why Tesla couldn't deliver on Elon's 550,000 vehicle guidance that he put out in October. I think that was a big driver, plus intensifying competition in the fourth quarter. Another positive driver was prepaid expenses and other. We'll discuss it later what it exactly means. Net income was a modest positive driver, and then when we look at sort of the main negative drivers of operating cash flow in the fourth quarter, so receivables is where basically Tesla has outstanding payments from customers, and this absorbs cash because you book in, and keep in mind we start from net income. In the net income, you book that revenue from the customer, but the customer hasn't paid you yet, so the cash isn't here yet because you start from net income, which in cash perspective, in terms of receivables increase, is overstated. You have to deduct these receivables that you haven't received yet, these payments, and that's why it's a cash flow negative. And then you have the opposite item, payables. Payables is where Tesla has to pay bills to suppliers, etc. And it's a negative because the amount of payables actually reduced. For example, if you can extend payment targets with your suppliers, it's a cash flow positive. But Tesla significantly reduced payables, and we'll discuss this in very great detail in a moment. And these are clearly the two most significant drivers. Plus, interestingly to note, we earlier talked about other income, and you can see that the net income included unrealized gains of FX, so that there was some FX gain in the quarter. But again, keep in mind, this is not the absolute amount, this is the change. So, and if you remember, in the third quarter, there was a roughly 270 million negative impact from FX. So the swing it's basically a reversal of the third quarter FX loss. And when it comes to FX loss, what you have to keep in mind, these are just basically accounting values, because it's not like Tesla is losing any money. It's just the value from due to changes in foreign exchange changed, and a company like Tesla has huge company so balances, cash balances in local currency. It's not like Tesla's money, all of it sits in like in US. Tesla has a huge operation in China, in Europe, etc., and other countries and regions. And so Tesla has huge cash balances outside the US. And for accounting purposes, Tesla has to consolidate all these amounts. And consolidation just means you have to add everything up. It's not that Tesla moving all this money to US dollar. Tesla just has to account for it in US dollar. And if the US dollar moves adversely or favorably against these currencies, it has a negative or positive effect on Tesla's cash balance valuation, and this effect is accounted here in unrealized gains or losses. So, and because it affects the P&L and therefore the net income in the cash flow perspective, because cash is not changing hands, you have to neutralize that effect, and that's why you have this adjustment in the operating cash flow. So then let's start with the first main negative driver of operating cash flow, and it was payables. So here is payables shown as you can see it on the face of the cash flow statement. Keep in mind there's also payables on the balance sheet. It's always important to know exactly what you're looking at. And you can see that there was a positive effect of 1.1 billion in the cash flow statement from payables. So payables increased, but the positive effect was significantly less than in the third quarter, and that's why in terms of the bridge I showed you earlier, the quarter-on-quarter effect was a negative 1.2 billion. If you remember this one, so this is the 1.2 billion here, and this 1.2 billion is the reduced positive effect from payables. Just to keep this in mind, and this is often poorly understood. People assume, oh, payables go up. This must mean Tesla is not paying suppliers, etc. This is a wrong way of looking at this, and to show you what I mean, it's good to use this commonly used metric, the days payable outstanding, and the way you calculate is shown down here. So what you do is you you take the accounts payables from the balance sheet. Typically, you use average because it gives you a better metric, and you divide it by the cost of revenue, and then you multiply by days of the relevant period you're looking at. In our case, we're looking at quarters. It's also a typical way to show it, and this gives you the DPAs, days payable outstanding, and you can see in this time series that actually fourth quarter was actually Tesla's in a long time by far fastest supplier paying quarter, for lack of better wording. And so Tesla is paying actually its suppliers quite quickly by automotive standards. There are some companies that are paying even faster. Toyota, for example, is known to be one of the leaders in that area. But from memory, I think Tesla actually pays faster than all of the Germans, and much faster than any of the Chinese players, which tend to have very high DPOs. So this is a slide I just skipped, and this one breaks down payables, because in Tesla's case, Tesla combines actually accrued liabilities and other, which I abbreviate as ALO, and accounts payables, AP, is actually combined in Tesla's cash flow statement. And if we look at what each is, I put down here sort of an explanatory note. So the ALO comprises accrued purchases, which includes goods and services received but not yet invoiced. And importantly, it also includes the accrued warranty reserve, the current portion, so the one that is expected to be used over the next 12 months. And because Tesla's fleet and also energy business is growing quite substantially, you would expect this amount to consistently increase, and that consistently therefore creates an increase in the ALO, which is part of payables. And that's why even if Tesla keeps paying suppliers completely constant, the payables have like a permanent tailwind. So you would expect them to go up, and also and it also includes payroll and other related costs and taxes payable as Tesla's scale increases, as earnings, as operating profits go up, as people, as number of employees increases, the payroll, etc. Yada yada. Tesla will see a permanent positive cash flow effect from increasing accrued liabilities and other. So the bottom line, and now I jump back to the DPO chart. Tesla's payables look very healthy. The DPO, so the payables boost in cash flow was like completely expected and normal development in for a business like Tesla, that it keeps growing its scale, etc. And therefore it's basically a nothing burger. I mean, the key takeaway is it's not a negative, it's positive. DPOs are going down. This is an indicator of health outside of a company in distress, and Tesla clearly isn't in distress with 36 billion in cash, positive operating income, etc. So this is clearly a marker of business health, and Tesla ensures that it keeps its suppliers healthy. And this can be also a strategic advantage, because suppliers love companies that pay quickly their bills, because this reduces capital consumption at the supplier's end. So this is the end of part 12, and then in part 13 we'll be discussing Tesla's inventory.